Video opens with a dramatic, almost eerie soundscape. No intro music yet, just tension. Voiceover: what if I told you the biggest reason traders fail isn't bad strategy, or market crashes, or even bad luck? It's something far more insidious. Something you control, but probably don't even realize is sabotaging you. Voiceover: imagine meticulously researching a trade. You're convinced it's a winner. You execute. And then, you lose everything. Not because your analysis was wrong, but because you made one critical mistake before you even placed the order. A mistake that has nothing to do with market direction, and everything to do with how you manage risk. Voiceover: this mistake destroys more trading accounts than any recession or black swan event combined. And it's shockingly simple to fix. Voiceover: today, we're revealing a mathematical formula. A secret weapon, used by the most successful professional gamblers and shrewd investors for decades. It's a formula born from Bell Labs, designed to optimize growth and, crucially, prevent ruin. Voiceover: this isn't about predicting the future. It's about building an unbreakable system. A system that tells you exactly how much to bet on every single trade. Ignore it, and you're gambling with your financial freedom. Understand it, and you unlock a pathway to consistent, sustainable wealth. By the end of this video, you'll possess this powerful tool. Voiceover: most traders focus relentlessly on finding the next big trade. They hunt for signals. They analyze indicators. They obsess over entry and exit points. And while strategy is important, it's only half the equation. Voiceover: here's the brutal truth: a winning strategy, applied with the wrong position sizing, will still lead to ruin. Think about it. You could have a strategy that wins 70% of the time. Sounds great, right? But if you bet 50% of your account on each trade, one losing streak, one bad run of 3 losses, and you're wiped out. Voiceover: this is the gambler's fallacy in reverse. Traders get emotional. They chase losses, doubling down to get back to even. Or they get overconfident after a few wins, betting the farm on the next one. This isn't trading. It's self-sabotage. Voiceover: the market doesn't care about your emotions. It doesn't care about your gut feeling. It follows mathematical probabilities. And if your position sizing isn't aligned with those probabilities, you're playing a losing game. You're risking your entire financial future on impulse, rather than cold, hard math. Voiceover: you might scrape by for a while. You might even have a few big wins. But without a disciplined approach to how much capital you allocate to each trade, it's not a matter of if you'll blow up your account, but when. This problem plagues new traders, experienced traders, even sophisticated funds. It's the hidden trapdoor in the journey to financial freedom. Voiceover: the solution is elegant. It's precise. And it's been staring us in the face for over half a century. It's called the Kelly Criterion. Voiceover: developed by John Kelly Jr. at Bell Labs in 1956, this formula was initially designed for maximizing long-term wealth in gambling scenarios. But its application to financial markets is revolutionary. The Kelly Criterion tells you the optimal fraction of your current bankroll to bet on a given trade, to maximize your long-term growth rate. And critically, it does so without ever risking ruin. Voiceover: it sounds complex, but the core idea is simple: you bet more when your edge is higher, and less when your edge is smaller. It's a dynamic, mathematical approach to capital allocation. Voiceover: here's the simplified formula for the Kelly fraction, F. Voiceover: let's break it down. P is your probability of winning. This is your win rate. If your strategy wins 60% of the time, P equals 0.6. Q is your probability of losing. That's simply 1, P. So, if P equals 0.6, then Q equals 0.4. B is your win/loss ratio. This is your average profit on winning trades divided by your average loss on losing trades. If you typically make $200 on a win and lose $100 on a loss, then B equals 2. Voiceover: let's run a quick example. Imagine a strategy with a 60% win rate, P equals 0.6, so Q equals 0.4. A 2-to-1 risk-reward ratio, B equals 2. Voiceover, plugging that into the formula. F equals 0.6 to 0.4/2. F equals open parenthesis 1.2 minus 0.4 close parenthesis divided by 2. F equals 0.8/2. F equals 0.4. Voiceover, this means the Kelly Criterion suggests you should bet 40% of your available capital on this type of trade. Now, before you panic, most professionals use a fractional Kelly. Half Kelly or quarter Kelly is common. For our example, a half Kelly would be 20% of your capital. This makes the strategy even more conservative, providing a significant buffer against variance. Voiceover, the beauty of Kelly is its adaptive nature. As your bankroll grows, the absolute dollar amount you bet also grows, leveraging the power of compounding. If your win rate or risk-reward changes, the formula automatically adjusts your optimal bet size. It takes the guesswork, and the emotion, out of position sizing. It turns your trading into a mathematical certainty, not a roll of the dice. Voiceover, this isn't just theoretical. The Kelly Criterion has a storied history of real-world success. Legends like Ed Thorpe, the mathematician who famously beat the casinos at blackjack and later revolutionized hedge fund management, used Kelly's principles to manage his capital. He turned a small investment into a fortune, not through luck, but through mathematical edge and precise position sizing. Voiceover, even Warren Buffett's approach to capital allocation, though not explicitly a Kelly calculation, embodies its spirit, understanding the odds, sizing investments appropriately, and avoiding catastrophic losses. It's about maximizing return while minimizing risk of ruin. Voiceover, let's look at a simulation. Imagine 3 traders, all with the exact same 60% win rate strategy and 2:1 risk-reward. 1. Trader A bets a fixed, arbitrary 10% of their capital. 2. Trader B gets greedy, betting 50%, over-leveraging. 3. Trader C uses a fractional Kelly, say 20%, half Kelly. Voiceover, Trader B, despite having a profitable strategy, blows up their account due to a few consecutive losses. Trader A grows, but slowly. Trader C, using the Kelly Criterion, shows optimal, accelerated growth, avoiding ruin and compounding wealth at the fastest sustainable rate. Voiceover, this is why the Kelly Criterion is so powerful, especially for passive income generation and AI trading. AI systems can meticulously track historical win rates and risk-reward ratios with unprecedented accuracy. This means an AI can calculate the optimal Kelly fraction for every single trade in real time.